The global economy is undergoing a contraction which is seen from virtually every single country at this time. Whether you look at the US, China, or Europe, you see what cannot be denied. Assets cannot seem to rise steadily as they were in 2017 and prior. Tensions are heating up from every single angle. No matter how long you dig into this, you will not find any magical substance or entity which will turn this around. You came here for the truth, so let me unveil that for you. Today we're going to look at the contractions that are taking place today in the global economy. We're going to look at the US, China, Europe. I'm going to show you several statistics, and I wanted to begin by taking a look at the United States. This is from economica.blogspot. You've probably seen the charts before. I found 3 that were particularly interesting, and I wanted to show you this one first. This compares the monetization versus the Wilshire 5000. The Wilshire 5000 gives us a broad view. We're looking at all the US stocks instead of just looking at, for example, the tech-heavy NASDAQ. This is able to give us a much more wide angle to be able to determine what's happening in US stocks, not just a few, not looking at the FANG stocks, for example. That's not giving us that wide angle that we need to see. So this here shows us the comparison, and it's clearly correlated. This is showing from the financial crisis up until the present, and you'll see that these two are obviously and completely tied together. When we zoom in and look at a more close view, the end of 2017, you'll see here that the Federal Reserve began their QT policy. It just happens to coincide with the dragging down of the stock market. Is that a coincidence? Of course not. You can see what happened here. We had the whole VIX situation in the end of January, beginning of February. Then everything started to calm down, so stocks began to rise in the United States. And then we had the October-November destruction that is still undergoing right now. Looking at this, we can see that it's clear. As soon as the quantitative tightening came into play, we had a very big problem for equities. US federal debt public versus intragovernmental debt outstanding. Ben Shalom Bernanke said that they will not monetize the debt. And they did it anyway. They asked Ben Shalom Bernanke, will you tell us who you gave the money to? Tell us who you gave the money to. He said no. Then they found out later they gave out $16 trillion. That's why he didn't want to tell them. But this gives us an idea of the monetization of that debt and how rapid the expansion was throughout this period of time. Public debt is that red line, and the intragovernmental debt, which continues to rise, of course, is the blue line, looking at nearly $6 trillion worth. The Fed funds rate is the dotted line, and that continues to inch up higher and higher. And you can see this, I've shown this many times before, every single time. They're never able to get it to where it was before. It's impossible. So this time around, we can expect at any moment they will be unable to raise this any further. It looks like pretty much right on cue, they're going to stop raising interest rates. Maybe we'll get December's interest rate hike, maybe one more. And that's it. The same thing happens every single cycle. Most people can't figure it out, but it's the same patterns repeating over and over and over again. If the central banks engage in a quantitative tightening policy, basically they increase interest rates, they lower their balance sheet, equities are going to be negatively impacted. That's it. That's the only way to put it. You don't need to be a genius to figure that out. Moving over to China, very quickly, just one chart I wanted to show you. The PMI has declined quite a bit here throughout 2018. You can see the direction that this has had. PMI obviously extremely important, particularly for a country like China. They are the manufacturer of the world. Even there, things are changing. And obviously, with so much of the tensions happening today and all the chaos that's brewing, this is only going to get worse as time goes on. Euro area economic confidence falls, complicating the ECB's mission. Now, the ECB said that they were going to stop their quantitative easing. They're going to reduce the amount of money that they're printing. happening, and by 2019 it's all over. Have no fear. We're going to be able to somehow sustain the growth that's barely there in the first place. And this is all at the same time that there's an actual contraction happening, there's deflation happening. There's no possible way that they could ever do this, but here they are continuously saying that they will, because they have to save face. They can't say that, oh, everything's screwed up and the euro didn't work from day one. They can't do that. So they have to pretend everything's okay, and then at the last second they scramble, come to a deal, and the people usually get screwed over in some sort of austerity type package. There's more details in here. Basically what it says is that the euro area economic confidence slipped for an 11th straight month. All right, so obviously this is not something that can be fixed. It only has to get worse. Losing confidence, euro area economic and consumer confidence both down in November. But look at the general trend here all throughout 2018. Again, with that whole QT policy, there is no possible way that this can grow. Doesn't matter what country you're looking at. If the central banks in general are pulling money out of the system, you're going to have a crash. You're going to have weakness. Now, you can have some pieces of some sectors doing well, but it's not looking good in the overall broad economy. Swedish economies shrink as trade slump hits Europe. I'll show you the charts on that in just a second. Questions about the strength of Europe's economy mounted further on Thursday after the Swiss and Swedish economies unexpectedly contracted and confidence in the euro area weakened. Economists had expected Switzerland and Sweden to expand, but output fell 0.2%. So not that great a deal here. It's not the biggest contraction ever, but they were expecting it to actually grow, and both of them contracted. Each was hit by a slowdown in domestic demand. Switzerland in particular suffered from a drop in exports. In the euro area, the latest decline in sentiment was led by a weaker consumer confidence, showing you Sweden first. Looking at this, the GDP quarter over quarter coming down. Not good for a country like Sweden. They really need this at this time, and unfortunately it did decline. Looking at the Swiss economy, again coming down at this level. This is really a surprise because you can see that it's basically been around 0.7 for the last few quarters, and then suddenly everything drops off. That's looking at different countries, whether we're looking at Sweden or other places in Europe, they all seem to be falling. So it's not just Sweden and Switzerland, but we look at the wider view, and it gives us the idea that maybe there is something such as contagion. We have to start looking at this very closely, and I'm seeing the mainstream media generally ignoring this information, ignoring the quantitative tightening that I believe is the most critical factor today. When you look at the central banks and what they're doing, you have to see very simply, look at their balance sheet, look at the interest rate. Along with that, you want to look at the LIBOR rate. This is very important because over $200 trillion worth of assets are trading through the LIBOR. You want to be able to see what's happening with the reserves of these central banks, see how much they're carrying with all the commercial banks. You want to know what they're doing, what they're up to, because they decide what happens with loans, with businesses, with jobs, and everything else as a ripple effect. So if you know that information, you're going to be much further ahead than the average person. There's no doubt about it. And in fact, you're going to be able to be ahead of all of those who think that they know what they're doing when they're out there trying to give people advice, and really they should be zipping their mouth. So that's all for this video. If you found it informative, please give me a thumbs up. When you give me a thumbs up, you're supporting this channel, so I do appreciate that very much. If you want the financial education you were not taught in school, these two books have everything you need, from the foundation, the history, the asset classes, making money, how to save on taxes. There's so many things in these two books. They fit into each other like puzzle pieces. So while they do cover similar information, I do cover some info that, for example, in Global Economic Collapse, I couldn't get into in the Money GPS. It just wouldn't have fit. So these two books, definitely check them out at the link in the description. If you're more interested in the audiobook version, you can get that at themoneygps.com. I keep forgetting to mention this, but I just wanted to let you know that I am now on iTunes podcasts, so you can download these shows. Every single one of them is going to be uploaded to there automatically. I figured out a way to do it. People have been asking me to do this for a long time, so all you need to do is on one of your Apple devices, go to podcasts, and then you can search for The Money GPS. It comes in video format there as well, so if you prefer it on the iTunes podcast platform instead, you can see me there. Please let me know if anyone is interested in this. You could subscribe to me on there. So check me out on there. Take care.